Howdy there, folks. Welcome into the buy one, get one free here today. Two videos for me to react to. First one up here, big tech stocks. This is from 2 hours ago. Big tech stocks are set to surge next year after the short-term turbulence that we're about to go through. That's an interesting perspective. I want to hear that there. Then the second video we'll react to is a 2023 economic outlook. Should the Fed stay the course? I think it's a very important subject that we must discuss. Now, I thought I would react to this video here today because, something I've definitely been finding myself in recently is watching and consuming a lot of bearish content and hearing a lot of bearish perspectives over and over again, whether it be videos, whether it be articles I'm reading, whether it be on CNBC and things like that. And I've almost been kind of tuning out bullish folks. Like somebody sent me a Tom Lee video earlier this week, a friend of mine, right? And I was watching a little bit of that and then I just kind of wanted to turn it off. And the reason being is obviously Tom Lee's always so dang bullish, always like the market's going to go to the moon and these sorts of things, right? So the one thing I'm trying to do is the best place to be in the stock market is balanced, right? And so I think I went way into 2022 way too positive, right? And then the Fed did something that none of us saw coming, right? Raised interest rates at the fastest clip pretty much in the history of the Fed, right? And like that was just like shocking situation. And this year I don't want to go in too bearish. I don't feel great about 2023, but with that being said, I don't want to go so far over to the bearish side because you get in a very unhealthy state. If you're all the way on the bullish side or all the way on the bearish side, you become what's called a perma bull or a perma bear. Not really healthy. It pays to be a little more on the bullish side usually, but not to be so far over to one side or the other, or you're going to end up probably finding yourself in no man's land and not being in a good place. So anyways, appreciate y'all joining me as always. I think we are over 20,000 subscribers now on the reaction channel. I'm glad you guys enjoy this channel, and let's go ahead and get right into this.
It sounds like you are willing to say there's going to be maybe some additional weakness short term, but that beginning next year, we're going to once again start to talk about the long-term potential around some of these franchises.
Oh, I have something very cool to show you guys here. Very important, okay? Let me show you this. This is very important. I showed this to everybody in the private stock group last night, essentially, in the Discord chat. So this is since 1970. We've only had 2 periods ever where we had back-to-back years of these negative stock market returns, right? Because obviously 2022 is a negative year. A lot of folks are expecting 2023 to be a negative year. You just got to understand how few and far between that happens. It happened here around 1973, 1974, back-to-back negative years there. And then we had back-to-back-to-back negative years when the tech bubble went okay, so that is just something to keep in mind, that if we have another negative year for stocks in 2023, that does not happen very dang often, okay? And I just think that's important so everybody's aware of that at least.
Exactly. We're a value shop, so we're value and dividend. We're rarely excited about technology companies. In light of the 35% decline in NASDAQ, in light of the 50 to 70% decline in a lot of companies, we are very upbeat about these companies. We think the worst is behind them. Might be some more short-term turbulence. However, if you look at a lot of these businesses, they're great businesses.
Short-term turbulence, meaning stock prices going down in the short term and volatility.
Many of them are selling at 15, 16 times earnings and a few under 10 times earnings. We think it's a great time to be buying. You have to close your eyes because short-term anything can happen. But we think a year from now, a lot of stocks could be 30 to 40 to 50% higher.
Wow, that's a big prediction. A lot of these big tech stocks, 30 to 40 to 50% higher, right? First thing up here, I agree with him. Yes, absolutely, it is a time to be buying many of the big techs. Apple, I'm still a little iffy on, but in terms of a lot of these big techs, Tesla, Amazon, Meta, even Google McDougal, although that one could have a little further to fall. A lot of those big companies are absolutely ready to buy. And even if you go a tier lower to like the PayPals and the Shopifys, those ones are ready to buy as well. Doesn't mean, you're not going to be able to get some shares, but as long as you've got a 6 to 12 month kind of like buy horizon in front of you, they're all 100% buys, basically over the next 6 to 12 month span. So I am 100% in agreement with him. And, if you're buying those stocks over the next 6 to 12 months, it's very hard outside of the Great Depression happening again. It's very hard for you not to make not just money, but like really good returns on those stocks as long as you're a consistent buyer over the next 6 to 12 months. So I am 100% in agreement with him on that.
Watching a lot of the big guys, Amazon, Google, PayPal, Qualcomm, Apple, how does that conversation happen even as estimates, in your view, are going to continue to come down?
Well, the estimates are coming down, but you have to put that in perspective. A lot of these companies normally sell at 30 or 40 times earnings, and today they're at 14 or 15 times earnings. Right now, the market is focused on negative.
Wait a minute. A very important point there is many of those companies in the past have traded at those valuations. Why have they traded at those valuations in the past, and what's different now? For two reasons, Kay. First one is the interest rates were around zero for most of those companies over all these years, right? And obviously, if the interest rate's much higher today, which obviously is substantially higher, we're talking about Fed funds rate in the 4s right now, right? Like what you're going to pay for stocks is just going to be far less than if interest rates are pretty much at zero. That's the first thing. Second part that's very important is many of those companies have shown actually much stronger growth in the past than they're expected to show at least over the next year, if not two years. And so people are looking at that and they're looking at Amazon's growth rate or Google or Meta or whoever, whatever company. Apple probably going to have revenues down in 2023. And it's not exactly the most comforting feeling in the feeling of like, we got to give this company a super big valuation or something like that. So I think those are two important points that maybe he's just being a little too bullish here in my perspective.
And we think you have an end of the year flush in terms of tax selling, in terms of portfolio window dressing. But we think that people are going to look beyond a weak 2023 toward 2024, which is a recovery, and say, hey, these companies are selling at 15 times earnings. They normally sell at 30 times earnings. Let's take Amazon, for example. They generally sell between 2 to 3.5 times sales. The average is about 2.8 times sales. Today, they're at about 1.65 times sales. So we think you're getting a lot of really good businesses, really good long-term prospects. We're less concerned about the very near term, but long-term, you're getting it at a great price. And long-term, these companies are going to come back very nicely.
But, David, it's interesting to me that they've reset in different ways. So you mentioned Alphabet. I think it's back at Q1 2021 levels. Amazon's back at Q1 2019 levels. And PayPal is way back to Q4 2017 levels. So are they at different points in their execution, in the viability of their strategies? Do investors need to be careful about seeing just that they're cheap? Are there different reasons why some of these names are cheap?
Well, there are different reasons why some of the names are cheap. However, in aggregate, the technology basket has been thrown, the baby's been thrown out with the bathwater. You want to look at the companies, you want to buy companies that have good long-term prospects. So we're still wary about the Zooms of the world that sold off, or the Pelotons of the world that sold off significantly because they were COVID stay-at-home plays. But the companies that we highlighted here all have very good long-term business prospects. We like the management of most of them by and large. We think PayPal has gotten religion in terms of cost cutting. We think they have great prospects, yet you're buying it at 15 times earnings. So we're less concerned about where the levels are back to. We're more concerned about the valuations and the prospects for the next 1 to 2 years. And we think it's a great time to be buying them if you're willing to look a year out. It's a painful time to be buying them if you're buying them today.
Yeah, no doubt about that. I was just kind of going through like how some of these stocks have done over the last 5 years specifically. We know a lot of these stocks have gotten absolutely wrecked over the past year, but I think it's just interesting to look at a 5-year on many of these stocks, and not all of them, but many of these big techs have done tremendously well over the last 5 years. And despite their stock prices come down considerably, but others haven't, right? You look at a Meta, you look at PayPal, they've done awful the past 5 years. But don't be surprised if stocks like that are the overperformers over the next 5 years. Amazon, only a 38% gain in 5 years on Amazon. That's pretty darn low nonetheless. Google McDougal's at 62% here. It's interesting that the two stocks that are falling the most are still been two of the best performers over the past 5 years, right? You look at Tesla, 449% over the past 5 years, and Shopify, 198%. So probably just, I definitely feel like there's probably some good tax loss harvesting going on in those babies, as it's been obviously just a horrible year for those two stocks. Next one up here, 2023 economic outlook. By the way, let me know your economic outlook for 2023. Are you bullish on the economy in 2023, or are you a little scared of the economy in 2023? I love reading through the comments and hear what you guys have to say.
For Steve Leishman, who no doubt kept his earpiece in the entire time. Steve, a 10 out of 10? I'm not sure I've ever heard of a perfect Fed score before from Kerry.
They don't get a perfect score.
I think Kerry understates it. I think it's like 12 out of 10 if he could change the game. Brian, you know what holiday it is, Brian? It's Festivus, and I got a lot of problem with you people, okay?
Uh-oh. Here we go, the airing of grievances.
No. Actually, it's the opposite. We had pretty good data today. I think we should talk about this. We had inflation kind of easing down a little bit and the consumer easing down a bit. If you want something to worry about, I'd worry about the consumer. We had a robust October spending spree, and now we had a kind of a zero or a goose egg, just a little bit of spending in November. And the question is, what happened in December? What I'm interested in is this chart. I don't know if it's been made. We had a little technical problem, but it shows that you have outright goods deflation right now, Brian. And it's the service sector that still remains high, but has been coming down. Look at that. Betsy Spring, Merry Christmas, Happy New Year. Got it done in a nick of time there, despite the technical problem. You see that?
Wow.
Guys, you only see three down negative months on goods there, but it's actually 4 of the past 5 months have been deflation. And then there's that yellow bar. That's your services bar. Thanks, by the way, to Joe Busuelas, who calculated for me the number that Powell's looking at, the services, core service.
Did they get their colors mixed up here?
Ex-housing at an annualized rate. That's 2.7%. So we're kind of moving in the right direction. The market wants to say we're there already. Powell wants to say, you know what, we're going to wait a little bit till we declare mission accomplished. So what I have here going in, one more number, guys, before we end this, is I'm looking at a 65% probability of a 50 basis point hike for February 1 for the all-important 10 out of 10 Fed meeting.
Steve, I'm looking at is that inverted? Is goods yellow or blue? Which one is the deflation on the?
Thank you. I was trying to. That's why I went down the comments. I'm like, am I tripping here, or is somebody pointing this out?
Far right side.
Goods is blue.
The one that's showing the big drop.
Blue. Is that? Goods is blue.
Okay.
That's
the go back to the
there,
thing. Yeah, it shows goods being yellow on the legend. The key above it.
We made it in a hurry because of the technical problem. I'm sorry, guys. My bad.
All
but the
good.
blue is the good thing.
Don't worry. I just want to make it clear. No. Correction needed. I want to make it clear because I was curious about it because you were talking about 3 of the last 6. That's a pretty steep deflationary environment for goods. I mean, that's a huge drop. And Tom Lee of FundStrat says that's a positive sign.
Just for you, you know what's coming down? I got the data right in front of me here. You got your used car prices coming down, your new car prices coming down. So, my friend, if you're not in the market, now is the time. And I'm very interested what's going to happen because one of the things that brought down spending was car spending in this particular month. And I'm wondering what's going to happen. Let's say you get those cars on the lots. The dealers have cars to sell. You maybe get a few incentives in there. People have been holding off because prices have been high. You might get a rebound in consumer spending through autos while you have a deflationary impulse additionally coming from autos. So I think that's a good thing setting up for the new year. And I thought, why not?
I mean, my personal opinion is in terms of like buying cars or homes or anything like that, I feel like max pain is probably like, maybe second quarter, third quarter of 2023 through maybe the first quarter of 2024. That's kind of my personal opinion. If you're looking for deals out there, that's probably going to be, for whether it be cars or whether it be homes or anything like that. I think that's kind of that level of max pain there. That's kind of my personal opinion.
The good news for the day before the holiday.
Well, I love it. I'm actually in the market for a car, but I'm at a point now, Steve, it's still too expensive. They're not coming down. Yeah, well, my cars are old. So that's how I'm going to keep driving them until
you buying a car sometime.
I'm cheap. I love cars. I can't do it right now. Steve Leisman, thank you very much, my man. Great stuff, as always. Happy holidays, Steve. All right, we'll see you soon.
Okay, that was a little disappointing. I felt like they were to get more into the economy than that. I do think it's important. Obviously he's bringing out that a lot of these inflationary measures are coming down, right? And, we're getting a lot of the good signs you want to get. And if you're thinking about the Fed at some point in 2023 being able to hopefully pivot and maybe start bringing down Fed funds rate and maybe easing a bit in this whole situation, it's definitely a potential with the way things are trending. But But the thing we've learned about inflation, I think that everybody's learned in 2022, is you can't get too excited too fast in regards to any of this. There's been so many times that we got like a down month and it was like, okay, inflation's finally coming down, where it's done, it's only going to get better from here. And then it got worse, right? And then it got worse again, and then worse again. And it's like, I think all of us got very frustrated this year, and just like inflation and the Fed having to go crazy. Most of these Wall Street folks were expecting the Fed to end this year at about a 1% Fed funds rate. They're exiting the year at over 4%. That's like, it's hard to even like explain how insane that is in terms of what everybody's expectation was versus what the Fed actually had to do, because inflation was such an issue. So that's the issue for us in 2023, is even if we continue to see these numbers come in line, get better and better, and that CPI come down to 6 and then 5 and 4 and 3, it's going to be great and it's going to be wonderful to see, but we can't get too excited too fast. And do keep in mind, the Fed might want to see CPI at pretty low levels for a while, meaning several months before they start to bring down Fed's funds rate, unless they feel like the economy is really falling off a cliff, right? Then that's a whole different situation. So anyways, hope you guys enjoyed this video. As always, I did a very in-depth video on the main channel about probably almost 2 weeks ago now, and basically in the thumbnail it says like it has like 2023, and I actually recorded that one in the garage, and that one went into kind of my opinion and the economy and everything like that for 2023. I think that's an important video. I also posted another video about a week ago that went very in depth on the subject on the main channel, financial education. So if you didn't get to check out those videos, definitely go check out those. You'll definitely get some good value out of those. So appreciate you guys. Much love as always. Thanks for everybody that subscribed to the channel, and have a great day.